Redbox, sat in a jacuzzi, had ADT protect your home, driven through a Carl's Jr., bought craft supplies at Michael's, stayed at the Great Wolf Lodge, enjoyed games at Chuck E. Cheese's, taken a cruise on Norwegian Cruise Lines, gotten protein from GNC, had your ears pierced at Claire's, watched a movie at AMC, hit the slots at Caesars, or shopped at Sprouts, you've interacted with Apollo Global Management's massive investment portfolio. And these are just some of Apollo's consumer-facing brands. Apollo Global Management also has its fingers in dozens of companies in chemical manufacturing, business services, natural resources, trucking, and the telecommunications industry. But despite their massive reach, most people have never heard of Apollo Global Management. I didn't hear about them until I was in college doing a business strategy case about Redbox in like my junior year. So, considering it's such a massive company with $598 billion under management, it's kind of strange that there isn't much out there about them. So today we're going to change that by answering three main questions. First, and this one is by far the easiest, where did Apollo come from? Second, how successful are they really? And third, and probably most importantly, what makes them so successful? And can we learn from what makes them successful in making our own business ventures more effective or more profitable? But before we jump in, if you like learning about the business world, consider clicking that little subscribe button. I spend a ton of time researching interesting business topics so that you don't have to. And whether you're interested in why solar freaking roadways failed, which food delivery company is best, which AI is best, or why Yellow went bankrupt, I think you'll benefit from subscribing to my channel. Plus, it's free, and you can always unsubscribe if you feel like you don't end up liking the videos. But I really do think you're going to like them. Anyway, enough about that. Let's start by answering question number one, where did Apollo Global Management come from? The roots of Apollo are in the collapse of Drexel Burnham Lambert, which was the fifth largest investment bank in the United States at the time. Drexel Burnham Lambert, which is a terrible name in my opinion, went bankrupt because Michael Milken, one of Drexel's executives, condoned or encouraged, it depends on who you ask, unethical and eventually illegal trading practices in his role as the head of the high-yield bond division. At first, it was just charging above the legal markup for trades, but eventually it grew to be full-on insider trading. Until 2008, Drexel Burnham Lambert was the largest investment bank bankruptcy since the Great Depression. After Drexel's collapse, a bunch of its higher-ups were completely out of jobs, right? So Leon Black, the former head of Drexel's mergers and acquisitions department, teamed up with Josh Harris and Mark Rowan, who were other high-ranking employees at Drexel, to form Apollo Advisors, which would eventually change its name to Apollo Global Management. And despite Michael Milken being in jail and these three guys being some of his right-hand men, their reputations as savvy investors managed to survive the controversy, and they brought in $400 million for their first investment fund. Even with this substantial war chest at their disposal, in the 1990s there wasn't a lot of financing available for leveraged buyouts that were so popular among private equity firms in the 1980s. So Apollo's founders turned to an interesting strategy called distress to control takeovers. With this strategy, Apollo would buy securities like debt in companies that were in financial distress. And when that company eventually filed for bankruptcy, Apollo would convert that debt into a controlling equity stake in the company, and then use that control to make operational changes, cut costs, and turn the business around. For example, Samsonite is around today because Apollo used this exact strategy on them in the 1990s. So that's how Apollo started, and I listed a bunch of these companies that they've invested in, but I could have also just cherry-picked and left out a bunch of their failures, right? So how successful is Apollo Global Management really? Well, despite a couple of duds, Apollo has been on a run of monumental success over the last 30 years. From 1990 to 2021, Apollo's private equity funds generated an aggregate gross internal rate of return of 39%, and a net IRR of 24%. Now, I wish I could tell you how much money they made from each specific deal, but I can't for two main reasons. First, Apollo has held on to many of their investments, and they don't split up their revenue on their 10Ks by investment. Second is that usually the price Apollo is paying for a company is widely publicized, but when Apollo eventually sells the company, that price isn't publicized. For example, we know that Apollo bought Qdoba in 2018 for about $300 million, and they recently sold it to Butterfly, a private equity group focused on food, but the sale was not made public. This trend of the buy price being public but the sale price being private continues across most of their deals. But one example in Apollo's past that we do know the sale price for is their investment in LyondellBasell. In the midst of the 2008 financial crisis, LyondellBasell was a struggling chemicals and refining company that was really tight on cash. And when all the banks started struggling, they had a liquidity issue and eventually went bankrupt. Apollo acquired a multi-billion-dollar first lien loan and later converted it into a $2.1 billion equity stake in the company. Only 3 years later, in November of 2013, Apollo sold its investment in the firm for a total of $12 billion, which means that Apollo made a $9 or $10 billion profit and more than 4x its investment in only 3 years. Perhaps the biggest indicator of Apollo's success, though, is not in the headline-grabbing sales numbers, but in the fact that really smart people continue to invest more and more money with them. This isn't a silver bullet, though, because people kept investing in Bernie Madoff, and he's a fraud. The majority of Apollo's invested capital comes from the likes of pension funds, sovereign wealth funds, insurance companies, funds of funds, and endowments, while only 9% of their invested capital comes from high net worth individuals. And over the last 10 years, Apollo has seen its assets under management grow significantly at a compound annual growth rate of 21%. For their private equity, their compound annual growth rate has been 7%, for their credit facilities, it's been 34%, and for their real assets, it's been 19%. Smart people want to invest their money with Apollo because of its high returns and track record of success. Apollo has not only outperformed the S&P 500 over the past decade at an average return of 24%, but they've also outperformed many other private equity firms. It's obvious they've been pretty successful. So what makes them so successful? And is it actually possible to apply some of these principles on a smaller scale in either personal investing, entrepreneurship, or running a business? Actually, yeah. As I see it, there are 3 overarching aspects of Apollo's approach to business that we can mimic. Obviously, we can't copy them exactly. This is a multi-billion-dollar company after all. But we can apply variations of these principles in our own business strategies. Whether it's for a startup, a food truck, or a mid-sized company, there are lessons to learn here. So as we go through these, think about how you'd apply the concepts in other businesses, and if you want to discuss that in the comments below, that would be super fun too. The first principle of Apollo's success is that it continually looks for both new places to compete and new ways to compete. As I read through their history, financials, and all of their investor decks, I was really impressed to see how wide-ranging their investments were. Apollo doesn't limit itself to one industry or type of investment in which it competes. Apollo's team looks everywhere for value-based investment opportunities, and then they put good leadership in place to make the company run better and eventually reap the profits. They do chemicals, tech, hospitality, and entertainment, and by being open to all possibilities, they're able to see opportunities that they might have missed if they had been too narrow in their scope. In addition to looking for new places in which they can compete, they have continually looked for new ways to compete, whether that was through them adopting the distress to control takeover techniques in the 1990s, or leveraging private credit facilities and retirement funds more recently. The second thing Apollo does that makes it so successful is it purposely built mutually beneficial synergistic relationships within its divisions in the company. Now, I know this sounds like a bunch of corporate bullcrap, but I really couldn't think of a better way to describe what they've done in one sentence. They've created these synergies in 2 different ways. First, Apollo has built itself in such a way that whether crap hits the fan or not, it can make money. Remember how I said earlier that one of the ways they got into private equity deals was by loaning out companies money, and if/when the company went bankrupt, Apollo would swap their debt for equity and go in and fix it up and sell it? Well, they don't just loan out the money hoping the company goes bankrupt. A huge portion of Apollo's business, about 70% of their assets under management, is essentially being a bank by lending out money to companies and making interest off these loans. They're able to make consistent returns while not having to worry as much about whether the companies will go bankrupt or not, because if the company does go bankrupt, they can have the corporate fixing team come in, fix the company up, and sell it for a profit. This is obviously oversimplified, but do you see how the different parts of Apollo work really well together here? The next way that Apollo has created synergies within its structure is by creating a mutually beneficial relationship between itself and a retirement company called Athene. Let me explain. Most alternative asset managers must keep raising money each year to invest. This means wasting lots of time trying to convince rich people or groups to invest. This time could be better spent analyzing investment opportunities or doing some other value-adding activity. On the other hand, retirement funds have a steady source of money and want to invest some of that money in investments that will see high returns. Since many retirement funds are very large and have a long time horizon, a portion of their capital can be invested in things that aren't easy to sell quickly, like alternative investments. And as long as the retirement fund has exposure to a wide variety of alternative investments, the risk stays relatively low. So Apollo needed more money to invest, and retirement funds were a great place to get money. Do you start to see this shark or more relationship forming here? Understanding the potential benefits of this kind of relationship, Athene was founded in 2009 with Apollo as the only manager of its assets. And eventually these 2 companies merged together in 2022. This combination of a retirement fund with the investment side gives Apollo a unique competitive advantage in that it is more easily able to have significant amounts of cash on hand to take opportunistic investments when they arise. The last key to Apollo's success is that they aren't afraid of failure. And I don't mean they aren't afraid of failure in the same way your middle school drama teacher tells you to chase your dreams and not be afraid of failure, but I mean they do their analysis, know the risks, take them, and are okay with some of their investments failing. Sure, they would love it if every investment they made turned out, but the reality is that's just not how the world works. So they accept it and take their shots to the best of their ability, and they end up making a lot of money from it. Like it or not, our lives will be full of failure. The most successful people on the planet have tons of failure stories. Whether it was Disney being fired from his first job for not being creative enough, Tom Brady not getting drafted until the 6th round, Michael Jordan getting cut from his high school basketball team, or any of the actors that were told no a bajillion times before they got their first big role. Failure is a necessary part of life. None of us will avoid it, so we all need to do our analysis, think things out, decide what is the best option, and then just go for it. If we fail, then we'll pivot, but we can't live in fear of failure. Apollo Global Management has been successful because it constantly looks for new ways to compete. It creates synergies in its business that help it be more profitable, and it's not afraid of failure. If you guys have any stories of people who failed before they made it big, I'd love to hear about them in the comments below, and not just like the basic Disney ones, but other ones too. As well as if you think I missed any important details about Apollo Global Management's rise, or what's made them successful, feel free to put it down there too. Thank you guys so much for watching, I'll see you guys next time.